Hi everybody, this is Alan Ellman, the Blue Collar Investor, welcoming you to Lesson 5 of our Beginner's Corner information series on selling cash secured puts. I can't believe we're past the halfway point. I really hope you're enjoying the series so far. In Lesson 5, we're going to discuss the calculations for both exercised and unexercised put options. Thus far, we've discussed some of the basic option principles necessary for selling cash secured puts, and we've also reviewed the process of selecting the best underlying securities for this great strategy. In today's lesson, we're going to go through the calculations that will let us know how much cash we can generate from the sale of our put options, and also how much of a discount we can generate if the option is in fact assigned to us. So there are going to be three formulas we're going to discuss. The first one is if the put is not assigned. And that will happen if the price of the stock closes above the strike price of the put that we sold. In that case, the put holder will not elect to exercise that option. Let's think about that for a second. Let's assume we sold a $50 put, and the price of the stock closes above 50, let's say 52. Well, the put buyer is not going to elect to sell those shares to us at 50 when they could be sold at market for 52. So the option expires worthless. We keep the put premium, and we calculate our returns by taking the put premium and divide it by our cost basis, which is the strike price minus the premium received. And you're going to see this come alive in an example coming up shortly. The second formula we're going to review is if the put is in fact assigned to us. And that will happen if the price of the stock dips below the strike price at expiration. Here we can calculate our net cost of the stock and our break-even price point. And the formula is the strike price minus the put premium will equal our break-even point and our cost basis. And of course, we multiply it by 100 for the contract. Will give us our cost basis for one contract. So let's help make this all come alive by looking at a real-life options chain for Coors, which at the time was trading for 81.64. Now you can see on the options chain I've highlighted two strike prices, the $80 out of the money strike because it's lower than the current market value, and the $85 in the money strike because it's higher than the current market value. Since most of us are going to be selling out of the money put options, let's focus in on the $80 out of the money strike, which generated a bid of $2.20. Okay, here's a look at the BCI put selling calculator, and we take the information gleaned from the options chain and we put that into the blue cells at the top. And then you could see we just put in the trade date and the ticker symbol of the stock. Remember, the current market value was 81.64 and the expiration of the contract was December 15th. Strike we're looking at is the out of the money $80 strike, which, if you recall, generated a bid of $2.20. Now, once you put that information into the blue cells, the yellow cells will become automatically populated. Now, if the price of the stock remains above the strike of 80, then the put will not be assigned. So we calculate our return on our option, if unexercised, and you could see that is 2.83%. We get that by dividing 220 by our cost basis of the $80 strike minus the put premium. So $7,780 per contract is our cost basis. So our 1 month or 31-day return is 2.83%, which annualizes out to 33.29%. Now, what if the option is exercised if the price of the stock dips below the $80 strike? Well, the information is the same in the blue cells at the top, and you can see that our cost basis or our break even is $77.80. We get that by taking the $80 strike at which we purchased the shares and deduct the $2.20 premium we received. So our cost basis is $77.80, which represents a 4.7% discount from the original price of $81.64 when we first entered the put trade. Now, there are times that we're going to close a position mid-contract, and that information is detailed in my books and DVDs in the exit strategy chapter. What we're going to do here is give you an example. because as the price of a stock goes higher, the value of the put goes lower. Remember, the put buyer has the right to sell at the strike price. If the current market value of the stock keeps going higher and higher, the value of that put option goes lower and lower. So let's make a hypothetical example here. Let's say we entered the put trade when the stock was trading at 32, and we sold the out-of-the-money $30 put for $1, so we generated about a 3.3% one-month return. Now, if the price of the stock moved up, let's say to 36, that put value will go down, perhaps to 10 cents. So what we could do if it's mid-contract is buy back the put at 10 cents. Our calculation would be as follows. The $1 generated from the initial sale of the put minus the 10 cents cost to close divided by our cost basis of $30 minus 1 or 29, and that represents a 3.1% 1 or 2 week return depending on when in the contract we closed our position. Now, the benefit of doing this is that that cash that secured the put is now freed up to secure another put or generate a second income stream in the same month with the same cash. But the way the formula works is you take the cash generated from the sale of the put, deduct the cost to close, and divide it by your cost basis. Now, to get a free copy of the Basic BCI Put Calculator, just go to our website, thebluecollarinvestor.com. The red arrow shows you a link that says free resources, including the Ellman Calculator, and there you will find the BCI Put Calculator and also the Basic Ellman Calculator for covered call writing and many, many other free resources that we're happy to share with you. So to summarize, 3 formulas necessary to learn are the one for unexercised puts, where the price of the stock remains greater than the strike price at expiration, an exercised put, where the price of the stock dips below the strike price by expiration, closing a contract mid-contract when the price of the stock accelerates, making the value of the put option much lower. And those are the 3 formulas that you need to know. And of course, the Basic BCI Put Calculator will help you in that regard. Now, in Lesson 6, we're going to discuss how to execute a put selling trade. We'll do it for you step by step so that once you get involved in the strategy, you'll know how to go about calculating the returns and then executing the trade. Thanks very much for watching Lesson 5. Hope you benefited from it. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.